Okay, we are going to go ahead and get started. Thank you so much for joining us for the benefits of real estate professional status. This is a topic that has a lot of complexities to it. So, Christine, I'm going to let you kick us off, and then we'll dig into the content.
All right, sounds good. Good evening, everyone, and thank you for joining us tonight. And if you are viewing this as a recording, thank you for watching the replay. And we're excited for this topic tonight. And before we get into the details, a little disclaimer. So the following content is for informational purposes and of general nature. We're here just to have a discussion and have some fun and talk about a really cool idea. So the information shared, conveyed, and elucidated in this presentation is not intended to constitute any legal, tax, or accounting or investment advice. And so any ideas or strategies here should not be taken by any individual without prior consultation with a professional, whether it's a financial, tax, or your own independent research. So again, just want to say this can be a loaded topic and has a lot of complexities around it. So it does vary for individuals' circumstances. So please, if this is of interest to you, please follow up with your real estate CPA. And I do want to emphasize real estate CPA because there are many CPAs out there who
Yes.
are not as privy to these strategies because it's just not their specialty. So someone who does specialize in real estate will know exactly how to guide you and give you the best strategies. So from there, we're going to give a little introduction about ourselves. So I am Christine Shu and joined with my co-founder, Margaret Kozlark of Nobly Vest. We're really happy to be with you here tonight. So a little bit about Margaret first. She's invested as a GP, LP, and fund manager in over 1,900 doors across Texas, North Carolina, South Carolina, Florida, and Indiana. She also has her real estate license with Sotheby's International. So she does have the perspective of a real estate agent, so it'll be really interesting as we talk about the real estate professional status. A little bit about me. I am a full-time real estate investor. I own 6 properties in Philadelphia and in Westchester, which is where I'm based here in New York, and also a GPLP fund manager and have JV partnerships with a few others on a few deals. And those are in Texas, North Carolina, South Carolina, Georgia, Florida, and Ohio, and spanning across over 2,000 units. So a little about us at Nobly Vest. We have just around 293 million assets under management across single assets and funds. And so that's comprised of over 1,400 units across our portfolio. And yeah, we're just excited to kind of serve you and bring really great opportunities to you in real estate. So we're going to go ahead and jump right in. I'm going to pass it over to Margaret.
Oops, goodness. Sorry about that. Hold on one second. Gotta love live video. Okay. So just to tell you a little bit about what we're going to be discussing tonight, we're going to start with talking about the biggest challenge for high income earners. I'm sure you can guess it. And even if you weren't a high income earner, I guarantee you it affects you as well. Then we'll talk about the benefits of investing in real estate, and then the benefits of investing in real estate when you have rep status, which is real estate professional status. And we're going to talk about what that is, how you qualify for it, some little strategies for some high income earners, logistics of it, got a case study, and then a special note for all of my realtors who are joining us today. And then, of course, we'll have Q&A at the end. So there's a lot of information we packed into this presentation. We will be sharing the deck with you. So if you have any questions, feel free to put them in the chat and we will either get to them at the end or get to them if it's appropriate during the presentation. So let's dig in. Okay, So no surprise, the biggest challenge really for any of us is taxes. But especially when you are a high income earner, the taxes can eat away a huge chunk of your earnings. And so we all know there are traditional strategies which can help, but they are not enough. Things like maxing out your 401k contributions, donating thousands to charity, writing off business expenses. But the problem is that as your income increases, these tax deductions can phase out. So basically, your tax bill keeps increasing. You don't really have a lot of relief for it, and it ends up with a lot of frustration. For high income investors, getting that rep status is one of the most powerful tax tools that you can have. It can potentially lower your tax bill from 35% down to 15%, sometimes even lower. So I'm going to talk about what that is. But before I do, let's just talk in general about some of the benefits of investing in real estate. So the big one, of course, is deductible expenses. So when you invest in real estate, you can invest, as this is assuming you're an active landlord, you can deduct rather the mortgage interest, the taxes, the insurance, any maintenance fees you do, depreciation, as well as any business related expenses, which would include legal and accounting fees, office space, advertising, and travel. But there are limitations, and this is where it gets tricky. Your max deductible is capped at $25,000 a year. So you cannot deduct any more than that amount, and you can't deduct anything in excess of your rental income. So if you have a rental unit and you end up net positive $9,000 at the end of the year, that's all that you can deduct from that. You can't deduct the full 25. And it starts to phase out as your income rises. So as you go between 100 and 150,000, it gets lower. And then once your annual income is above 150,000, then you can't even deduct the 25,000. So that really leaves you subject to capital gains on these gains, capital gains tax rather. But if you can invest with rep status, which again is that real estate professional status, then you can get some significant tax savings. So the general presumption by the IRS, and I should clarify that rep status has actually nothing to do necessarily with what you do as an individual. So for example, for my real estate agents out there, you're not automatically considered a real estate professional in the eyes of the IRS. They have some very specific criteria that you have to meet to hit that qualification from a tax standpoint. So the general presumption by the IRS is that real estate rental activities are passive, and passive losses cannot be used against active income, specifically income from a W-2 job. However, let's say you're married and you and your spouse file jointly, you could have depreciation losses from your real estate investment go against that normally high W-2 income, which can really dramatically reduce your taxes. So, and we're going to get into some examples of this. But first, let's talk about what real estate professional status is. So it is under the Internal Revenue Code, section 469C7. There's another reg that has to do with consolidating your rental properties together. But basically, the gist of it is that if the taxpayer, in this case you, spends the majority of your time in real property businesses, so you have to meet half personal services, there is a 750-hour threshold. Again, I'm going to get into the specifics, but if you meet those criteria, then you qualify for real estate professional status in the eyes of the IRS. And if that's the case, when I talked about that $25,000 limit, that goes away. And so now those rental real estate losses are no longer considered passive. So if you materially participate in the activities, the losses can be fully deductible. So let's talk first of all about how you would qualify for reps. So the three main requirements are you have to spend at least 750 hours a year doing activities related to the rental income. You have to have greater than half of your professional time. And this is where a lot of people get stuck, because let's say you are a W-2 employee and you do real estate on the side. whatever amount of time you spend at that W-2 job. So let's say you work 40 hours a week, then you have to, on average, do at least 41 hours, qualify for rep status, just for that second piece. So it could be a lot of hours. And I will say, if you have a W-2 and you try to qualify as real estate professional status, you're almost guaranteed to get audited by the IRS. So that's why a lot of people kind of divide and conquer with their spouse. And then material participation is the other one. And this is really key, because you could be a full-time investor, let's say, have a bunch of rental properties. However, if you are hiring property managers and landscapers and a whole team of professionals to handle a lot of these day-to-day activities, you can't then try to tell the IRS that you are the main person handling the property management or going to the units and mowing the lawn and that sort of thing. So the key word is that material participation, and you have to qualify for all three of these criteria in order to meet that rep status. So let's dig into them each individually. So I mentioned the 750-hour rule. So you have to spend at least 750 hours a year on real property trades or business during the year. So these could be things like development, construction, acquiring the property, could be a conversion, finding tenants, interviewing tenants, operation, management, leasing, anything related to that. What's not eligible are things such as education, so listening to podcasts or reading books, searching for new properties. And this is a big one where a lot of times people mess up here, because the whole idea is, if you're spending a lot of time finding your next rental property, it's not your property yet. And it's entirely possible that you could spend days or even weeks looking for something that doesn't end up becoming a property that you own and produces income. So that's where you have to be really careful with this. In addition, other ineligible activities include studying financial statements, preparing any kind of summary for finances, assuming in a non-managerial capacity, as well as commuting to and from to see this property. So just to give you a general idea, I wanted to break down the math of what 750 hours a year looks like. So if you assume that you're going to take 4 weeks off a year for vacation or holidays or whatever it might be, that leaves you with 1,750 hours divided by those 48 weeks, and it comes out to be 16 hours a week. So essentially, basically 2 days a week, every week. So that's a lot. That is a big commitment. And as I'll show you in a moment, you also really have to be careful with your documentation on that. So the next criteria is greater than half of the professional time rule. And this is the one where, in addition to spending those 750 hours actively engaging in those qualified real estate activities, you also can't spend more time working at something else other than real estate. So real estate can't be a side gig. It really has to be your main gig. And for example, if you are there are some real estate agents who work for a brokerage and they just get a flat fee. So they're essentially W-2 employees. Unless you own at least 5% of the company, that would not be considered, it would not meet this rule in terms of the half of the professional time rule. So this is the big one. Let's talk about material participation. So to qualify as materially participating, your activity, first of all, has to be done on a regular basis, and it has to be substantial. So the IRS has several ways to qualify this. The good news is you only have to meet the standards for one of them, but it is specific. So for example, you participated in the activity for a substantial amount of time, which could be anywhere from at least 100 hours to 500, depending on the activity. Your participation was most or all of the participation of that activity, as opposed to anybody else. So for example, in the example I gave you before, if you have rental properties and you have a property manager, but you're trying to qualify for material participation by saying that you were managing the property and you were collecting rent and interviewing tenants, but your time that you spent doing that is less than that property manager that you hired, then you would not be able to qualify under this particular criteria. And then again, the other one, it has to be regular, continuous, and substantial during the year. So let's talk a little bit about that when we get to some examples. So what do you do if you're a high income earner? So we have a lot of people that we work with at Nobly Vest who might be doctors. We have a lot of IT folks, and these people are making really good salaries, but as mentioned, they're getting killed in taxes. So one of the ways that you look at this is, with that 750 hours, if you have a full-time job as a doctor or an attorney or an IT person, there's no way that you can do it. First of all, it would be really difficult just physically managing to do it. But the second thing is that the IRS would see all those hours that you're spending on your W-2, and then really be suspect that you're spending more time on your real estate. And if you were able to make it so that you were spending more time in real estate, well, then you're spending less time at your W-2, which means you're not earning as much money because you may not be working a full-time hour. So it's kind of this catch-22. What a lot of couples have done that we work with to get around this is that they assign one spouse to be the rental person. So for example, let's say you've got a high income earner, could be the husband or the wife, they're a doctor, an attorney, whatever it is, that person can go all in on their career. And then the spouse might be the person who's mainly managing their rental properties. And this person is, of course, logging their time. They're meeting all that criteria, materially participating more than half their time, at least 750 hours a year. So if that person can claim that rep's designation, then all of the losses, all of those passive losses from the rental income can also offset the W-2 income. So let me show you an example. So again, let's say there's two working spouses, one's full-time, the other's, working part-time, but they're doing the couple's real estate investments. In the other examples, the one I just talked about, one is full-time, maybe the other is a homemaker, but they decide that they're going to make their job managing those investments. In both of these cases, the spouse that's managing the real estate has to really commit to truly doing it, because they have to meet that 750 hours, and they have to absolutely be good about documenting their time and what they're doing. And I'll show you a little bit later what I mean about that. Logistics. Planning is absolutely key. Before you even start this, what you're going to want to do is meet with your CPA. At the beginning of this, Christine talked about how everybody's situation is different. Everybody's CPA is also different. You absolutely need to have a CPA who understands this. And sometimes it's not even enough to have a CPA who understands real estate, because they don't always all really understand the benefits of the real estate professional status. And there are some very specific things that they have to do. So for example, it's not enough for you to just check a box that say you're a real estate professional. There's a specific section where you have to declare it. And also, if you have multiple rental properties, you have to declare that you are going to be counting these hours towards the properties in aggregate. And if you don't do that, you may not qualify. And if you get audited, you could end up owing additional taxes to the IRS. So it's just really important that you speak with your CPA and make sure that you're setting this up really well before you, decide to go into it. The next, of course, you want to set aside funds to identify target markets, specific neighborhoods, the type of property that you want to do, and start shopping for those investment properties. In addition, you want to make sure you have everything separate bank accounts, separate accounting program, a separate email address, any kind of business systems, that will help you track your expenses. Everything like that should be completely separate from anything that you're doing in terms of your communal money in your personal life. So you need to plan your work and work your plan. Because if you are qualifying for real estate professional status, this is essentially your job now. right? So you have to treat it like a business. You have to have your systems in place. You have to have a plan for things like when you're going to raise rents, renew leases, if you are doing any kind of planned renovations. So have that all laid out. And then each day, you want to start the day with an idea of how you are going to maximize your profits that day, of course, while simultaneously improving the tenant's experience, because a happy tenant stays and a sticky tenant is a lot easier for everybody. So you want to make sure to track your time and activities. You can do this certainly with Google Calendar. It helps you coordinate with any contractors as you're doing renovations. And you definitely need to track all of these activities closely and provide as much detail as possible. So, for example, the IRS requires that you keep a log, again, if you're going for this rep status, of your hours of service during the year. So you can use whatever method of your choice there is. There is an Excel workbook, appointment books, online calendars. There are some apps that do this, but whatever you choose, you want to be consistent. And at a minimum, you want to include the date, whatever the activity is performed. So be as specific and as detailed as possible. Were you with somebody? Was it a conversation with a property manager? Were you shopping for tile for bathrooms? As much detail as possible. The duration of the activity. And this is a really important one because people have gotten audited. And I feel like by default, when we track our time, we all tend to kind of round, right? Oh, I spent an hour doing that. I was 2 hours doing this. The IRS does not like that. It would be better for you to say, I went into this meeting at 8 o'clock and I finished at, 8:37, whatever it is. It's very specific and it's much more credible than if you just round. And then, of course, you want to include the related property address. So like, here's an example. You could have the date, met with the property manager, review the prepares, now in this one, ironically, I did say 2 hours, but you could also say, hour and 13 minutes or whatever it is. And it's fine to do 2 hours. Sometimes you just don't want to do it all the time. In addition, the IRS is going to look. So let's suppose, heaven forbid, you get audited. They are going to want to see this and they're going to ask you a lot of very specific questions, not just about your activity in real estate, but they're also going to want to know about your life in general, right? So maybe you've got some kids shopping for college. Maybe you just had a baby. They're going to be doing this mental tick in their head to decide, is it logical that you would have legitimately, while putting a child, shopping around for colleges, dealing with a newborn baby and the exhaustion and work that goes with that, would you still likely have that 750 hours that you could have devoted, or is it possible that you're fudging? So having this documentation will go a long way to showing them, as opposed to having to look back and say, okay, let me go in my Calendly. What did I do that day? Oh, I think I did this. And they can tell that you're just kind of guessing and filling in some blanks. So let's talk about a case study. So let's suppose Charles and Jen are married. They have a 2-year-old son. Charles is an IT professional. He makes about $250 a year, and Jen takes care of their son, and she manages the family's rental properties. The properties are cash flowing, but because she's using a strategy with depreciation, she has generated $60,000 in real estate losses. Now, just to be clear, these are paper losses. I mean, unless the property is really doing bad, but usually you employ depreciation because you want to get a loss to offset the gain. So if Jen can qualify as that real estate professional status, then she can deduct the $60,000 in losses off the family income of the $250,000. So this is how it would look. So the first column here is if she is not able to qualify for professional status. So you see Charles' W-2 income of $250,000. The rental income that came in was $15,000, but because she accelerated depreciation, she created a net loss of $75,000. So her net loss rather is $60,000. However, she can't really do anything with that. She could take $15,000 of it and actually, no, she couldn't. You know why? Because they make more than $100,000. So they're kind of stuck. So now that $250,000 is going to pretty much get the max of the federal and state taxes, which in this case is about 45%. So the total taxes they would have to pay would be $112,000. But now in column 2, let's imagine that Jen does qualify for the real estate professional status. So now she can take those $60,000 in rental losses, deduct it from the income, which brings their base down to $190,000. So she's already decreased the amount of income that they'll be taxed on, and she's managed to push them into a lower tax bracket. So in this scenario, they're getting taxed at a 40% rate. So the total taxes here would be $76,000. So she just saved her family $36,500 by using this real estate professional status. So before we go on, I do want to say a little bit something to my realtor friends here. For those of you who don't know, I am also a realtor as well. I work with William Pitt Sotheby's here in Westport, Connecticut. So I work with investors on both sides, both active and passive with syndication. Rep status is not automatic. So people may think, oh, I'm a real estate agent, I'm already qualified as a professional real estate professional, not in the eyes of the IRS. You have to show, you'll certainly likely meet the 750 hours, right? Especially if you are a full-time realtor. However, you still have to meet the requirements for that material participation. And of course, you still have to show that over half of your time was spent on real estate. And this cannot apply to clients. This can't be investors that you are working with to help find properties. This has to be your personal real estate investments that you are trying and spending time on. However, there is an upside for realtors. As you may know, there are many things that we can deduct, including subscription fees, dues, licenses, everything from desk fees, software, any coaching, training. So there's a lot of things out there that realtors can still deduct, whether they are an active investor or not. I did want to point out, however, things like cell phone mileage, office expenses. Of course, this is assuming it's not 100% of your time. Let's say you don't have a dedicated car for your real estate business, then you obviously have to only deduct a proportionate amount that you are using. So at this point, I hope I haven't discouraged everyone like, oh my gosh, so I have no time to be an active investor. The 750 rule freaked me out. What do I do? Invest passively is what you can do. So with real estate syndications, you can get all the benefits of investing in real estate, but you don't have to do any of the heavy lifting. So you help fund the project. We handle the details. We find and close the property. We identify and train the property management. We execute the business plan, whether it is handling renovations, loss to lease, identifying any new income streams, and you get to receive monthly updates and enjoy cash flow, appreciation, and depreciation, risk mitigation, tax deferment through a 1031. So you get all the benefits, but you don't have to be that person out there doing all the work. So I'm going to open it up for Q&A, but just a final thought is that investing in real estate is a great way to reduce your taxes by offsetting gains or additional income if you qualify rather for that rep status. So consult your CPA to discuss your personal situation and what would work best for you. But no matter what, financial freedom is all about just going out there, learning what works for you, finding a real estate investment, whether it's passive or active, and basically getting in the game. So I threw a lot of information at you, I know, but I'm going to open it up here for Q&A and would love to take any questions that any of you guys may have about real estate status, what might qualify, what might not. Again, we are not tax professionals, but we can certainly give you our opinion. And then, of course, you'll want to check with your CPA.
Yeah, and as everyone's kind of thinking and really soaking it in, I just want to mention that, there's a lot of details around it. It truly is a commitment to implement this strategy into, your family's financial planning. But I do want to say that it is extremely beneficial and is very impactful and really makes a difference. So from my personal experience, I left my W-2 to become a full-time real estate investor qualifying for reps. And that alone, basically my entire W-2 income was paying for our family's taxes, all of it. And once I resigned from my W-2 and became a real estate professional, I was able to offset whatever we were paying in taxes. And basically it just saved the amount of money that I was already making and paying to the IRS. So just that alone replaced my income. So the act of me resigning from my W-2 to become a full-time real estate investor replaced my income. So just that act, even before any incomes and profits, cash flows from real estate. So it is extremely, it's really kind of like, it's really beneficial, it's really impactful, and it's really kind of a strategy that is secret to the ultra wealthy because it has been implemented time and time again in many of the high income earning families. So I just want to mention that.
Yeah, and I'm glad you shared your personal story, Christine, because I've been able to watch you, because when you and I first started chatting, you had that W-2 still. And it's kind of a crazy statement if you think about it, to say that all of your W-2 income was pretty much just going to pay taxes, right? So now you quit that job, and yet, you're still saving that amount of money, and you still have these assets which are also growing and appreciating. So it's, basically the tax laws are written to encourage investment. It's this is all very legal. We want to make sure that you speak with your CPA so you're doing it appropriately and correctly. But the way the tax code is written, they want to encourage investment in communities, and people need houses. Everybody knows what a crazy housing market it is. There's not enough housing units for people who need them. So that's why the tax code rewards people like Christine and like anybody else who may want to try for that real estate professional tax status. And so for my realtors out there, again, I know, for you, there are some of you guys who, have 30, 35 properties. This would be perfect for you. For those of you who are out there thinking, I don't even know how I could manage one rental property. I am so busy running around showing houses, doing open houses, that sort of thing. For that, then you may want to look at doing something with a syndication. So you won't get all the tax benefits that you will as a qualified real estate professional in the IRS's eyes. However, because of the way that the syndications are structured and depreciation, it will offset your gains. So you will defer taxes on the gains that you make, which means you can keep more money to invest in other deals. And then at the end of the 5 years or 3 years or whatever it is, you have the option to use that 1031 exchange to just roll that into another property. So it's kind of like you keep kicking that tax can down the road. And so the more money you have to invest, obviously, without them shaving off taxes, the snowball gets bigger quicker. So are there any other questions from anybody out there? I know it's a big kind of complicated concept that some people have sort of heard some about. Sometimes investors didn't even know that this existed. So are there any questions that we can answer about real estate professional status, or even anything about, investing, syndication, anything like that? Please put them in there. And while you are doing that, I just want to share our contact info. So this is my contact info and Christine's. You can also follow us on social media. We are on Facebook, Instagram, LinkedIn. We have a YouTube channel. And if you are interested, most of the people on this call have either invested with us or we've had contact with. But if you haven't had a conversation with us yet and you are interested, reach out and schedule a call. We are not high sales pressure. We don't do that. It's just an SEC requirement because some of the deals we do are what's called 506Bs, which means we have to have a pre-existing relationship. So we need to understand you and what your goals are. And that way, if we have a project that could be a good fit for you, we've already had that pre-existing relationship established. So definitely encourage you to do that.
Yeah, and we would also love to just meet you and get to know
Yes,
you.
of course. Absolutely. And we have a free educational series, things like this. We do webinars every month on a variety of topics. So, a lot of times some of our investors will reach out and suggest topics for us as well. So we always love that kind of feedback. So, all right, Christine, I think we've stunned everyone into just a brain freeze. So what we will do then is we'll go ahead and wrap up. But if you do have other questions, sorry, apparently my dog has a question. If you do have any other questions, feel free to reach out to Christine or myself. We're happy to go over, review anything with you. And, you know, like I said, if you do think either A, you could be close to qualifying for that rep status, or you just want to know more about it, absolutely encourage you to speak with a CPA and make sure that your CPA is well versed in that specific qualification. And you can ask them, you know, maybe how many clients they've worked to help get that status. So, okay. So then with that, we are going to go ahead and, you know, say good evening. Thank you so much. We appreciate your time. And as always, reach out if you have any questions. Have a good night.